basically how you can get a mortgage in the UK. So what this webinar is the 4 key pillars of actually getting a mortgage here in the UK. And really, to simplify that, it really is how can you actually get a mortgage? And you'll see throughout this presentation that there's really these 4 key areas or 4 key pillars that determine your ability to actually get a mortgage here. Before I actually dive into it, I'll give you a bit of background about who I am and why I'm qualified to speak about this topic. So my name is Ripley Salgueiro. I'm the foreign national mortgage specialist, and what that means is that I specialize in helping people that have moved to the UK really in the last 5 years to buy their first home here. Of course, some of my clients are kind of fit outside of those brackets, so I do have clients that have lived here for a lot longer than that. However, predominantly it is people who have moved here and are on visas in the UK. I've helped hundreds of people through the process of buying their first home in the UK. So I've seen almost everything that can happen through the home buying process, and I certainly know it's not an easy process to go through. The reason why I've ended up specializing in helping people that have moved to the UK more recently is just because I saw how difficult it can be when you are in the UK on a visa, not just because of your visa status, but also because the process is so different. And the process of buying a property in the UK is very different. I know I saw on the chat there's people from sort of all over the UK here, which is great. And the process also differs in England versus Scotland as well. So it does get rather complex. Now, just to start off with, the first thing I want you guys to know is yes, it is possible to get a mortgage as someone who's in the UK on a visa. And the more we get into this webinar, the more you'll understand about what actually decides whether or not you can get a mortgage. And what you'll also notice is there are some things that you can work on that can improve your chances essentially, or improve your ability to actually get a mortgage here. So the most important thing to remember out of this is, yes, it is possible. And unfortunately, we do hear quite often from clients that they've spoken to other advisors or they've maybe spoken to their bank and been told otherwise. But I am here to tell you the complete opposite and say, actually, it is possible and it might be easier than you initially think. Now, to give you a summary of what these 4 key areas or 4 key pillars of actually getting a mortgage in the UK and what they are, to summarize them, they are so how much you're earning, what the structure of those earnings are. Secondly, deposit. So how much money can you actually put down towards this home purchase? Thirdly, your residency status. So normally that is if you're in the UK on a visa. If so, what type of visa and how long you've also been in the UK. Finally, it's credit score. And more broadly speaking, this is actually credit profile. So it's not just the score that matters, it's the entire credit profile, which includes a lot of things, but I'm going to break down on this webinar, of course, each of these 4 points in a lot more detail. So to start with, one of the most important things and really something that actually decides how much of a loan that you can get from a lender in the UK is your income. So at the simplest level, what a mortgage lender is looking at, or a bank, is they're looking at your job. So let's say you're employed and you've got a basic salary. They're looking at what that income is. They're then looking at any committed expenditure. And that really determines how much of a loan you can get. And we otherwise call that your mortgage affordability. So to start with your income structure, so lenders consider what the structure of the income is. So it's not just as easy as saying, this is how much I earn and then getting a mortgage. If you are paid hourly, some lenders will look at it differently than if you had an annual salary. If you have overtime income, for example, like a lot of my clients do, then again, that can be looked at. And lenders might take varying percentages of different parts of your income. So it becomes very complex to really decide, okay, this is how much you can actually borrow. And of course, that's where someone like myself comes into it as a qualified mortgage advisor, to help guide people through that process. Now, once we understand the structure of your income and we know exactly what elements of that we can use, then we're looking at the committed expenditure, which is the second part. So things that might come under this and that might get included for you could be existing financial commitments. So credit cards, loans, childcare costs as well. So any nursery fees or anything like that, if there are any, and dependents. So if you've got 3 or 4 children, that of course gets factored into things as well. Now, at the very simplest level, and to simplify it, typically you can borrow between around 4.5 times up to 4.75 times your household income. But this does vary depending on your circumstances. And the reason for that is because of the income structure, really, that I mentioned, and the committed expenditure. Um, as I've mentioned, with the income structure, it can change a lot. So it will give you a rough idea, saying 4.5 to 4.75 times your household income. And that could give you a vague idea of what you might be able to afford, but to really understand it specifically, you'd need a professional to look at what the structure of your income is, what your committed expenditure is, and complete what we'd call an affordability assessment. Now, to move on to the deposit requirements, really the minimum deposit that you can use in England or Wales is 5%. And there are between 1 to 3 lenders that can potentially do this if you do not have indefinite leave to remain. So if you were here, for example, on a tier 2 or skilled worker visa, as it's known, it is possible to buy your first home in the UK with a 5% deposit. Now, I'll get on to more the residency requirements to do that a bit later on, but really you have to have lived here at least 12 months to use that 5% deposit, and it becomes a lot easier the longer you've been here due to credit scoring. Now, something that you can do that's quite clever is getting an incentive or a deposit incentive from a developer. So you can only do this if you are interested in buying a new build property. But what some new build property developers do is they might offer you a 5% deposit incentive. So that's 5% of the property value, that you could use towards your deposit. And what that means is if you had 5% deposit and they gave you the other 5%, then in total, together, that would equal the 10%, of course. And what that's really useful for doing is it gives us access to more lenders. And some of those lenders that it gives us access to actually have some of the cheapest interest rates in the market. So, of course, very useful, right? Because that will mean you'll end up with cheaper monthly payments and will probably go through an easier process as well. Now, I've mentioned already some of those benefits of having that larger deposit, and it doesn't matter whether you get the 5% from the developer or you have the 10% yourself or you get a gift for some of it from someone else. Using that 10% deposit is a great mark to aim for. So even though it is possible to use a 5% deposit, if you can, using a 10% deposit is really good because it gives you access to those more lenders, as I've mentioned, and that therefore gives us access normally to some cheaper interest rates as well. And really, with the 10% deposit, if you're comparing someone that's lived in the UK for 20 years or someone that's got a British passport with someone that's moved here 12 months ago, 13 months ago, if they're both using a 10% deposit, the interest rates available are very, very similar. So there's not much of a premium that's then paid. Now, when it comes to the third key pillar, residency status, there are a few considerations. So the first one is your visa type. So the common ones that are fine with every lender: skilled worker visa, health and social care visa, dependent and spousal visas, and a graduate visa can also be acceptable to some lenders as well. There is one lender that can potentially allow student visas, but normally it wouldn't work due to there's other requirements and other restrictions around that. So generally, the ones that are acceptable are the ones that I've put on the screen there. For some lenders, they would want anyone who's on a dependent or a spousal visa to be applying with the visa that they're dependent or spousal upon as well. So that's important to mention. Now, when it comes to the length of time in the UK, if you have lived here for less than 12 months, it still can be possible to buy your first home here. But really, what you need is a 10% deposit or more. There's a couple of reasons for this. The first one is lender criteria. So there is only one lender really that can allow us to arrange a mortgage with less than 10% deposit if you haven't been here 12 months, and they have an income requirement of normally £100,000 per annum or more. So it's a very high barrier to breach. So for most people, what we'd require is for you to have lived here for longer than 12 months if you want to use a 5% deposit, and ideally closer to 24 months, so for 2 years. And the reason for that is it then gives us access to more lenders with a 5% deposit, and the interest rates come down slightly as well. Again, a 10% deposit is the ideal place to be. And also, having been here in the UK for 12 months, again, really helps with that. The final consideration when it comes to your residency status is the time that is remaining on your visa. So if you have less than 12 months remaining on your visa, it then can become a bit more difficult to arrange the mortgage. To be perfectly honest, as long as you've got more than 6 months remaining, it can be fine. It just starts to make it more difficult. And when we're looking at the timeframes of actually arranging the mortgage, of course, the longer that we've got left on the visa definitely helps. Now, this is the final pillar, and this is the importance of credit score. And I mentioned this at the beginning, but when it comes to credit score, really what we're talking about is your entire credit profile. So the first thing to note about this is that there are different credit reference agencies, and each of these have different scoring profiles. So I don't know if anyone who's actually in the webinar probably has downloaded different credit reports from the UK, and you'll notice that one will say a score like this, you might have another one that's got a score down here, and it can all be a bit worrying and all be a bit confusing. So they use different scoring metrics. Now, how the lenders do it is normally they will use one of the different credit reference agencies in the UK, but they'll also have their own metrics, their own requirements. And a lot of this can depend on where you're living, what your job is, how old you are. There are so many factors involved that it makes it almost impossible to actually determine or guess if you're going to pass the credit score without us doing something that is called a pre-approval. And a pre-approval is also known as an agreement in principle, a mortgage in principle, or a decision in principle. And what this is, it's a process that we go through with a lender before you found a property, and ideally before you've even started looking at properties. And this is where we go to the lender, we give them your details, so like name, date of birth, address history, income, etc., and they perform a soft credit check. And the idea of this is that hopefully you pass that check. And what that gives us is a certificate stating that you've passed the check with that lender. And what I also would have done as the advisor is I would have, by that time, we would have had a conversation. We would have looked at your documents. We would have done a full assessment based on your circumstances. And then we would have that agreement in principle from the lender. And really, once we've done all of that, that's what I call a pre-approval. So it's that whole process and making sure that, okay, I've looked at your documents based on the conversation that we have had, based on my conversations with the lender and the agreement in principle, I'm able to pre-approve you for actually getting a mortgage here in the UK. And that is where we find out if you pass or fail that credit check. And for some people, if you were to fail the credit check with a 5% deposit, it might actually pass with a 10% deposit. So if there is a fail of the credit score at that point, What I do with clients then is just give them a few tips, a few pointers of what we can do as the next steps. So quite often, if that does happen, it's not you can't get a mortgage. I never turn around to my clients and say, sorry, you can't get a mortgage. I don't do that. I would say, look, this isn't possible right now, but these are the steps we need to take, and this is what we need to do. Now, when it comes to actually building a credit profile, which is normally a question I get asked quite a lot, and it's a difficult question to answer because it's not straightforward. There isn't one rule fits all, but there are a few things that you can actually do. Before I dive into those, I'll just give you a bit of an overview of what the different time lengths actually mean. So, if you've been in the UK for less than 12 months, of course, you're going to have a limited credit profile. And this normally means the absolute minimum deposit you could use to buy a property in the UK would be 10%. If you've been in the UK for 12 to 18 months, of course, your credit score is developing, it's getting better, hopefully. Normally, there for most people, it probably still will be 10%, but it definitely can be 5%. And I do arrange mortgages for people who have been here between 12 and 18 months with a 5% deposit. So it definitely is possible. Once you've been here 18 to 24 months or longer, 5% is much more accessible as long as you've been doing the right things. Your credit profile becomes a lot more established. And when I say the right things, really this comes down to firstly making sure utility bills and things like that are correctly registered. You've not had any missed payments on those. Um, your credit cards and other loans and things like that. Again, you're not missing payments. If you haven't used any credit yet, it can be a good idea to use some. But I always say to my clients, it's very important that you don't go out and get 3 or 4 credit cards and then get a loan just because you want to build your credit score. Because what it does each time you take out a credit facility is it does a hard credit check, and that knocks down your credit score each time you do that. So, of course, if you do that 3 or 4 times, it's going to have a quite a dramatic effect. Whereas if you got one credit card, sure, it might knock your credit score down, but the idea is over time, as you make those monthly payments and ideally pay back any money that you spend on that credit card in full each month, what that does to your credit score is it starts to go up. So the general idea with a credit score is you're just building proof that you can use credit and pay it back on UK soil. Now, I like to leave this with just a few actionable steps, because really it all starts with a plan. And I speak with a lot of people who genuinely believe that they're way too far away from it and it might never happen. But I like to say to people that it definitely can, and it all starts with a plan. And that is so true. I've worked with people from being very early on in the process and getting them to the stage where they can actually buy. And it definitely all starts with a plan and these 4 things on the screen. So the first is you can actually do a basic affordability assessment yourself. And it's very important that I stress this affordability assessment isn't going to be an indication or a realistic or very accurate indication of how much you can get as a mortgage, but it will give you a rough idea of what might be possible, and it can help you to start to plan. So there's two sides to this. The first is having a look on Rightmove. So this is a property website. A lot of you might know of it. So if you type Rightmove in on Google, you can have a look at properties in your local area and start to get a general idea of how much properties cost or how much a property costs that you might actually want to buy. What you then want to do is have a look at your household income, and you could times it by 4 or 4.5 times and just see if you're generally there or thereabouts in terms of how much you can get as a loan. Of course, as I said, it's not going to be the most accurate idea, but it will get you within a range and it will get you to start thinking of how much you might be able to afford. Of course, if there are properties that you like that might be within your budget, you can start to think about how you can get your deposit together. So, as I've mentioned a couple of times, what you want to do ideally is aim for a 10% deposit, but 5% can be possible. And I've mentioned already, if you're looking at new builds, what you can do is use 5% sometimes from yourself and sometimes 5% from the developer. It has to be a developer that is actually offering that, but quite a lot of them do. And it can be a lot easier to get it if you are what they would call a key worker, especially if you're working for the NHS or something like that. The next point is thinking about your residency. So doing a residency check. So what visa do you have? How long have you been living in the UK? And how long is remaining on that visa? So think about the points that I've already mentioned in this. Do you meet those? Is there anything that might crop up as an issue? The final point then is just working on improving your credit score. So maintain that clear credit history, make sure you're not missing any payments, make sure everything's getting paid on time. Using a small amount of credit and paying that back in full, ideally, again, can be a really good thing just to build up your credit, moving towards the future. So really, all you can see all four of these kind of key pillars, these key areas come together, and then that decides on your ability to get a mortgage. Of course, there is only so much that you can do yourselves and understanding that side and piecing it together. And then that is where someone like myself comes in when you're a little bit later down the line and more ready, once you've got some deposit together, is when working with someone like myself can help you to piece all this together, get in the best position possible, and actually get through the process whilst achieving the best interest rates and avoiding any costly mistakes. So on that note, if you did want to get in contact with me with any questions, of course, we're going to do a Q&A now, but if you had a more specific or personal question that you wanted to take offline, then you can, best place really to get to is Instagram. So if you've got Instagram, you can send me a DM on there, and it's very easy for me to get back to you and answer any questions. Again, YouTube is something that I'm on and put out a lot of useful content on as well. So across both of those platforms there is some quite useful content. And if you're ready to buy, if you've got your deposit together and you're thinking, what are the best next steps now? There's a link there that you could actually book a call directly in with myself as well. I can see there's quite a lot of questions that have come up. So as long as Tendai is happy, then I guess we'll dive straight into those.
Yep, please go ahead.
Perfect. Great. I'll scroll up and try start from the top. Fine. So first question, is it an advantage to have a higher deposit? Yes, massively, and for a couple of reasons. So the first reason is it makes the credit check easier to pass. So even if you've got a lower credit score or maybe some credit issues in the past, a larger deposit helps to mitigate those and makes it easier to get a mortgage. The second reason is it gets cheaper interest rates. So how this actually works is interest rates become cheaper in 5% deposit increments. So this is 5% deposit interest rates. Then once you get to 10% deposit, the rates come slightly down. And it keeps doing that up until about 40% deposit. So yeah, really does help. Eddie, are there any 0% deposit for those who lived longer than 5 years? So if you have indefinite leave to remain or a British passport, then yes, 0% deposit can be possible. There is one lender that does that. There is another lender that allows people to use a £5,000 deposit, which although isn't nothing, it's a lot smaller than quite a lot of deposit requirements. Other than that, there aren't any options available for traditional mortgages for anyone who's on a visa for a 0% deposit. However, there is one lender through shared ownership, through the shared ownership scheme, which is where you buy, let's say, for example, a 25% share of a property, and then a housing association owns the other 75%. That can allow you to use no deposit. So they actually lend you 100% of that share value, and then you're actually renting the rest of the property anyway. Their criteria is quite strict, and they don't allow anyone on dependent or spousal visas. So they only allow people on skilled worker visas and health and social care visas. So it's quite strict, but that's the only possible way of doing it if you're on a visa with 0% deposit, that is. Okay. Can someone on a 2.5 family visa on 10-year route, okay, and has lived in the UK for more than 5 years, get a mortgage? Yes. So if you're on a family visa, so on the 10-year route to rights to reside, you can get a mortgage. Yes. There are quite a lot of lenders, all the same lenders that lend to other visas that I mentioned are completely fine with that. I'm going through the process with multiple clients at the moment, actually, on that exact visa. So yes, it is possible. If you've been here longer than 5 years, there are also more lenders that you could access compared to if you'd been here for 2 years, for example. Can you get a buy-to-let mortgage with 5% deposit? No. So, but any buy-to-lets or investment properties, they require a minimum of 25% deposit normally. Some lenders 20%, but it's quite rare. So anything for an investment property that you want to rent out to someone would be a 25% deposit. What I'm talking about here is actually buying your first home in the UK, so getting a mortgage for a property to live in. Um, is there an ideal score that makes it easy to buy, assuming that one meets all the requirements? I'm presuming, Eddie, you're talking about credit score there. Really, the only correct answer to that is no. There's no ideal score, apart from the fact that the higher the score, the better, because it'll be easier to pass. Really, the only way of checking, as I stated, was through doing the agreement in principle process. But yeah, the higher the credit score, the better. Can one get a mortgage at 3 years in the country? Yes, you can. So again, as for most people, if you've been here longer than a year, it can be completely fine. Again, 10% deposit is ideal, but if you want to use a 5% deposit, if you've been here 18 months or 2 years, then there should be some lenders that we could use. Of course, when it comes to using a 5% deposit, credit score is harder to pass. So that's the really important things to remember. So you have to have quite a clean credit history to be able to use a 5% deposit. How much roughly if we say 10%? Yes, the 10% of the price, as someone else has correctly said. So really what you'd have to do there is go to Rightmove, as I suggested. So Rightmove is this website here. Oh, on the screen there. You could have a look at properties in your area and then get 10% of that amount, and that would be the figure you'd need for the deposit. What happens if I need to go back to my country, but still want to make the monthly payments? So I'm presuming that you mean if you'd got the mortgage, you'd moved into the property, and then a few years later down the line, you decided to move back to back home or back to that country. Ultimately, all that would happen is that you would be able to continue to pay your monthly payments. Um, of course, it's important for us when we're arranging your mortgage to understand your longer term plans, and mortgage lenders, or the majority of mortgage lenders, especially the cheapest mortgage lenders, which of course is what we want to use, want you to be in the UK. So it's important we'd understand your plans. But yes, technically, if you changed your mind a few years later or 5 or 10 years down the line and wanted to move back to your home country, you could technically still be paying that mortgage. Um, of course, it depends what you're doing with it at that point. Of course, if you're then renting the property out, it would need to be switched to a buy-to-let mortgage. It could then become quite expensive in terms of interest rates because you'd then be an international resident as well. Hopefully that answers the question. Um, do you offer your services for free if a call is booked for you? Okay, yeah, good question. So my services to take you through the entire process are not free, of course. So the reason I charge for those, of course, is to make sure that I'm actually giving a good level of service to the clients that I take on board, and I do pride myself in providing a very good service. The fee that I charge in total, if we went through the whole process and got you the mortgage and so on, is £495. So it's a very fair fee in terms of what the rest of the market does. Of course, we would have to go into detail about what you actually get for that, but there is a very good service behind that. That initial call is free, just due to restrictions on my my time, because of volume and being quite busy at the moment working with clients, that kind of one-to-one call I can only have with people that are actually ready to buy. So if you have questions or want to know more, and maybe you're not sure if you're ready, again, the best thing to do is drop me a message. If you've got Instagram, drop me a DM, and I'll come back to you and reply to any messages and any questions and help give you some guidance that way for now. Where is the link you mentioned? I will get them to send it out. I believe I hope that Tendai would be able to send that out to the list that have joined the webinar, so we'll be able to send that out. If not, this link on the screen here for my Instagram, the link to book a call is actually in the bio of that Instagram as well. How does it work if you have a 3-year visa? So again, that can be completely fine. The 2 points that are key here is how long you've been in the UK and then how long you've got left on that visa. So it's just making sure that ideally you're kind of in the middle of that tenure. You've been here 18 months and you've got 18 months left, or you've been here 2 years and you've got 1 year left would be ideal with that. I've been in the country for over a year and my spouse less than a year. How does that impact our chances? So for a lot of lenders, they'll want you to have been here 1 year, although as I've stated, there are lenders that can do it less than that. And there are also some lenders that, as long as one applicant has been here for 1 year, then they would class the whole application as of that person's residency. So it doesn't affect it too much. A lot of my clients, there was one of them that moved here first, and then the rest of the family sort of came over once they were settled. So that's fine. Great. Okay, share Ripley's details. Thank you. Which percentage deposit can you be handed over a house and then continue to pay, or how does it work? Right. So yeah, 5% deposit minimum, as I stated in the webinar. I know some people joined a bit late. 5% deposit minimum, but the ideal thing to aim for is 10% deposit. You get cheaper interest rates, would be able to access more lenders, and it doesn't require such a good credit score, which can be quite difficult to pass, like a 5% deposit does. So ideally 10%. Minimum credit score. What is the minimum credit score which is needed to get a mortgage when you're only 2 years in the country? Again, there's no minimum score. The higher the score, the better. If you've been here 2 years, potentially using a 5% deposit could work. Again, ideally aim for a 10% deposit. Do lenders actually want to see the 10% deposit when applying for pre-approval, or are you supposed, if you're at 7.5%, but within a few months can reach 10%? Yes, really good question, this actually. Yes, it can be possible to start the process with like just under 10% deposit and then save up to the 10% whilst you go through the process. The key thing with this is, if we're looking at your monthly income and how much that you normally save on a monthly basis, is it plausible that you would actually save that money over the next 3 months? I would say 2 or 3 months, but yes, that can be possible to do. That's fine. What does shared ownership mean? Yes, so someone has actually replied to that quite well. So it's where you buy, to keep it simple, if you had a house that's 100% ownership, you would buy 50% of the property, and the other 50% would be owned normally by a housing association. So what happens there is you buying 50%, you're paying a mortgage and normally putting down a deposit. On the other 50%, you're actually paying rent. So it's like you're half renting a house and half buying a house. But the good thing is it gets you onto the property ladder, and then you can actually scale up. So a couple of years down the line, you could go up to 75% ownership with most properties. And then ideally you could get out to being at 100%. So is it not allowed to buy a property to stay in and maybe later rent it out to another family? So yes, it is allowed to do. It's just, we have to be very careful about how it's done to make sure that you are meeting the mortgage contract that you initially agreed to. So the very a very easy way to distinguish the two is there's two types of mortgages. There's a residential mortgage and there's a buy-to-let mortgage. Buy-to-let is for renting out to someone else. Residential mortgage is for a property that you want to live in. So obviously, if you're buying property to live in, we get a residential mortgage. So if you then at a later date want to rent that out to someone, we have to be very careful about how it's done to make sure that you're not breaching your mortgage contract. But it is possible to do. Yeah. Can I get a mortgage if I'm outside the UK? Yes, it can be possible. It very much depends where you are living outside the UK, where your income is from, what passport you have. Quite a lot of factors involved. It's a lot easier if you are from or living in like the UAE, United States, countries like that. But yeah, it can be possible. With those, deposit requirements are a lot higher, normally a minimum of 25%. Is having credit cards compulsory on getting a mortgage, or if my credit score is okay, then that's fine? Yeah, if your credit score is fine, it's completely fine. I'm not saying everyone go out and get a credit card by any means. Obviously, that would affect your credit score, as we said. It's just if you're quite a way out from actually buying, that's one of the things that you can do to improve credit score over the long term. But if your credit score is fine, then definitely don't go and do anything rash and go out and taking loads of credit out. You can definitely build a credit score or a good enough credit score to get a mortgage without taking out credit cards. Apart from the deposit, what other financial obligations required, solicitors, etc.? Very good question again. So solicitors, well, I'll start with that one because that's what you mentioned. Depending on the property you're buying and the area, are normally between £1,500 and £2,000. A mortgage broker fee is normally around £500. So like myself, depending on the property you're buying, you might want to get a home buyer's survey done. So if you're buying an older property, it can be a good idea to do that because then that gives you a report on what might need doing to the property in terms of work, or what issues you might have. So it's a good idea to get an understanding from a professional. That completely depends on your property value, but let's say roughly around £700 for that. Then you've got moving costs. So you'd have to consider where you're moving from, where you're moving to decide that, furniture, etc. Of course, depending on where you're living. But I'm going to speak about England because that's where I live. Stamp duty, land tax. So that's the tax that can be payable when you actually buy a property. So that can be quite a big cost, but it depends on your situation. If you were a first-time buyer, then potentially you won't pay any stamp duty. Currently, you wouldn't if you're buying a property up to £425,000 if you were a first-time buyer. But it's important to, of course, do your research on that. There are calculators online that will tell you for your specific circumstances, for where you live, how much stamp duty that you would pay. So how much interest? Oh, can someone with a fair credit score get a mortgage? Yeah, I think I kind of answered that one. Definitely, it can be possible. Again, doing an agreement in principle is the easiest way of actually knowing if it's possible or not. If you haven't got your deposit saved yet and you're worrying about that, start saving for the deposit. Keep building up your credit score, and that will help. Okay. How much interest mortgage lenders? Okay, what's the interest rate that mortgage lenders are likely to charge if you're using a 10% deposit? Again, this completely depends on your specific circumstances, but mortgage rates on a 5-year fixed rate, as we're speaking today, which is the 4th of September 2024, could be as low as about 4.75% on a 5-year fixed rate if you're using a 10% deposit and you're on a visa. Again, it depends on your specific circumstances. If we can't use that cheapest lender, the interest rates, of course, go up from that. And with a 5% deposit, the interest rates are, of course, higher. How much are transfer and bond registration fees on average? I'm not 100% sure what you mean by that, but I'm presuming you're talking about like transfer taxes. That stamp duty land tax that I was speaking about if you're living in England. So if you typed in stamp duty land tax calculator England on Google, you'd be able to find a calculator that, depending on the property price, would give you a good indication of that. How much payment? Okay, so how much would you pay per month towards a house for £180,000 if you were to use a 10% deposit? I'll tell you what I'll do is I will give you a bit of a live example on this, if I can. Let's have a look. So if you were to use can you still see my screen, by the way, or is it stopped sharing? Hopefully it's still sharing.
Yeah, we can
I've
see
got
the blue
lines on it.
screen.
Okay, it doesn't allow me to pull up Google. Okay, I'll talk you through the example anyway. So if it's £180,000 with a 10% deposit, then your mortgage balance would be £162,000. Of course, the remaining £18,000 would be your deposit. Let's say you got that 5-year fixed rate. If it's an older build house, it'd be 4.85% as we currently speaking. And if you went on a 30-year mortgage term, so to do that, normally you would need to be kind of 35 years old or younger. That would be a monthly mortgage payment of £855. But that's just a general example. If that mortgage term was 25 years, it would be about £933. So hopefully that gives you a general idea. Of course, it depends on your specific circumstances. It's important to say. Right. What is the formula used by lenders to calculate how much they qualify for as a loan? The general formula is 4.5 times to 4.75 times normally your household income. As I stated earlier on in the webinar, it really does depend on the structure of your income, how long you've been in the UK, your credit score. There's a lot of factors involved. Which banks do you advise to bank with? Because I heard HSBC is good. If you're talking about to get a mortgage, it really doesn't actually make any difference. So if you bank with HSBC and we decide Barclays is the best lender to get a mortgage with, it doesn't matter. You don't need to then change your bank account to Barclays. Barclays would just take the mortgage payments from HSBC. If you're asking about just generally what bank, HSBC probably a good bank. Any large high street bank are normally fine. Are you able to have a mortgage paying interest only as a foreign national on work visa? Normally, no, if you're using a lower deposit. If you were using a higher deposit, i.e. 25% of the property value or more as deposit, then yes, it can be possible to get an interest-only mortgage. Interest only, by the way, for anyone that doesn't know, is where you're paying just the interest per month and you're not paying the loan balance down. So you're just paying the interest. So although the monthly payments are lower, you're not paying the mortgage down, which is bad really in the long term, especially if you're living in the property, because it's important to make sure that although we're getting the mortgage now and we really want the mortgage now, one day, 20, 25 years, 30 years down the line, we don't want that mortgage, because that's the idea, right? To own the property without the mortgage in the end. What happens if I've raised the 10% deposit myself? Will that work to my advantage? Yes, to Brenda. Yes, it definitely will. Definitely helps. Cheaper interest rates, access to more lenders, easier to pass the credit score. What are the milestones from the start of pre-approval, decision in principle, offer to purchase? Yeah, so the key milestones are pre-approval, and ideally doing that and getting a specialist to do that before you start viewing properties. But you want to make sure you've kind of got your deposit together, you're wanting to buy in the next 3 or 4 months. Then you could speak to a specialist and get that done. Then you go out and do your viewings. Once you found somewhere and you have an offer accepted, we would submit the mortgage application. We normally then get a mortgage offer within about 3 weeks. We're also submitting the applications for relevant insurances to keep you in your home as well, which is a very important side to the process. It's not just giving you this mortgage, but making sure that you're able to repay it. So that will all happen. In England, you would then get to a point where you would exchange contracts on the property, which is where you become legally tied into buying it. And then you eventually get the keys on completion. That whole process from actually having an offer accepted on a property to moving in, on average at the moment, probably takes 4 months. But it again depends on your specific situation and who you're buying the property from. If I die, will my partner be allowed to continue with my mortgage payments? It depends. So if you're both on the mortgage, then yes, the mortgage would essentially become his entire responsibility. What we look to do for all clients is arrange life insurance, especially when you're going through the process of buying a property and getting that amount of debt, is making sure that if anything is to happen to either of you, then we're putting you in a position from the onset where you will be covered. And we've thought about these eventualities and what might happen. And we're putting you in a position where we have these backups in place, like life insurance. Are you able to pay more than agreed monthly on the monthly payments? Yes, you are. So what you can do is make overpayments, and overpayments, you normally have an allowance of up to 10% of the loan year that you can overpay. So if you had a £100,000 mortgage in the first year, you could normally overpay £10,000 on top of your monthly mortgage payments without incurring any fees or charges. Recording. Okay. What is considered as a good mortgage rate and a higher mortgage rate? To be honest, it completely depends on the time, like when you're actually reviewing the mortgages available, and that's because what's good and what's bad is just relevant to the market at the time, right? If you go back many years, there were interest rates that were 15%. If you go back 3 years or a couple of years ago, there were interest rates that were 1%. So it depends at the time. So it's a bit difficult to answer that. I mean, if you're looking at the moment with a 40% deposit, there are interest rates starting with a 3. With a 5% deposit, there are interest rates starting with a 6. So that kind of gives you the range of the high to low. Let's say I want to reduce the years of mortgaging my house from 20 years to buy it in only 10 years. What should I do? Make overpayments that I was just speaking about is the best thing to do, and keeping that within your overpayments allowance, so that 10% per annum. Again, working with a specialist advisor here would help, because they'd be able to advise you on your specific situation, the actual numbers of what to do. Normally the best thing would be making those overpayments each month, and then once you get to the end of your fixed rate, if you had a lump sum that you wanted to overpay, it's possible to do that normally without incurring any fees as well. Can I pay more deposit, like 50%? Yes, you can. You'll get cheaper interest rates for doing it as well. And of course, your monthly payments will then be lower. So yeah, definitely possible. I need an explanation on leasehold and freehold. What is the difference? Yes. So essentially, freehold, you're buying the property and the land that the property's on. Leasehold, you're essentially just buying the lease of that particular property. So as far as it goes with what's better and are leaseholds okay? Yes, of course, leaseholds are fine. It's just be careful about how long is actually remaining on the lease. So you want to make sure if you're buying a leasehold property, then even when you come to sell that property, the person that's going to buy that off you, what are they going to think about the lease term? So, for example, if you're buying something that's got 105 years left on its lease, and then you sell it 15 years later, when someone comes to buy that and it's got 90 years, are they going to think that maybe there's not enough left on that property? So you just have to consider a lot of newly built flats or leasehold properties start with a lease of 999 years. So unless you're planning on living 999 years, then they'll be completely fine. Hopefully that gives you a brief explanation. It's difficult to just compare the two, but to give you a very simple statement, normally houses are freehold and normally flats are leasehold. There are some that differ, but normally that is the case. Other thing to consider with a leasehold as well is any service charge and ground rent, because that can be an additional expense each month. Can I reduce my mortgage payments by paying substantial amount towards capital? What are the implications to me? So yes, you can, of course, overpay, as I've already stated. That won't initially decrease your monthly mortgage payments if you're in a fixed term mortgage. But when you come to remortgage, then yes, it could, because your balance would be a lot lower. There are some lenders that can allow you to actually reduce the monthly payments, but normally it would work if you're making overpayments, it will reduce the balance. The payments will stay the same until you would actually go to remortgage. Can I rent one room out while staying in the house on a residential mortgage? Yes, that can be possible. Definitely can be possible. Most important thing there is that there's no kind of legal contract involved. If it's just a lodger, you're informally renting a room out. Yes, that can be possible. Again, we need to let the mortgage lender know as well. If interest rates are on a downward trend, is it wise to get a 5-year or get a tracker deal so you can fix on cheap one? So this question is obviously geared more towards thinking, where are interest rates going to go? I actually think the much better way to look at this, and how I advise a lot of my clients, is more in a risk management perspective. And the reason for that is because for the majority of people, it's a lot better for us to manage risk than trying to maximize return when we're talking about something as risky really as a residential mortgage and getting a mortgage and your family home, for example. We don't want to gamble with that. We want to make sure that you're safe. And so 5-year fixed rates, I mean, definitely with where interest rates are now, etc., for a lot of people can still be a really good idea. There are also 2-year fixed rates, which give you the certainty of how much your payments will be for 2 years. And then we can reassess in that time. With what's best for you, it completely depends on your entire circumstances. That is what I advise people on, but that requires one-to-one conversations and a full understanding of your circumstances. Can age be a factor when applying for a mortgage? Yes, yeah, it can. So really how this works is most lenders will allow us to go up to kind of your anticipated retirement age for the mortgage term. So for most people, that might sit around 68, some people 70, where you anticipate, you think, okay, that's when I will actually retire. So if the mortgage term can still be kind of 25 years up until that date, normally it doesn't have too much of an effect on affordability. If the mortgage term length, of course, let's say you're 50 years old and it needs to be an 18-year mortgage term, and you've got children and you've got some loans and stuff, that can have an effect on the mortgage affordability, so the total loan that we can actually achieve. So yes, it's a factor. Please explain, what does buying with a chain or no chain mean? So buying in a chain is where, if you're buying a property from someone that currently lives there and they are going to need to buy another property, so they'll need to move out when you move in. And to take it to more of an extreme, the person that they're buying a property off is doing the same thing. You'll see it's like a chain, because you rely on everyone else to move out of their property and move into a new one, to actually move into the property. So no chain would be yourself, for example, if you're a first-time buyer, because you don't have to sell a property to move into the new property. You could just move in. So that would be no chain. What is a remortgage? So remortgage is, so essentially what we normally look at doing when you buy a property, for most people, would be you'd go on a fixed rate mortgage of normally 2 years or 5 years. When you come to the end of that initial 2 years or 5 years, if you did nothing at all, you would go on to what the lender's standard variable rate is. And that's quite expensive, and it's more expensive than fixed rates in the market generally. So what we actually look at doing is a process called remortgaging. So if you go on a 5-year fixed rate when you first buy your property, when you get towards the end of that, we would then, so for my clients, they hear from me again. Lucky them. They hear from me again. We have a discussion about what the best thing is for them, what their plans are. Are they looking to stay in the property? Are they looking to move? And then look at getting them the cheapest interest rate again. So yeah, that's remortgaging. How much can we pay per year towards the mortgage as a lump sum to reduce our payments? Yeah, up to 10% of the remaining loan balance each year for most mortgage lenders. Some mortgage lenders allow more. It's obviously important to make sure that you check with them before doing so and that you're not then going to incur any charges by making them. Um, Perfect. Yeah, I think that rounds up. I've just been asked to sort of round up all the questions have been, but I think we have. Last thing for me, I'd just like to say thanks a lot for everyone coming. There's been about 180 plus people here, so it's been great, and hopefully you've all found that really helpful. It's honestly been a pleasure. My main goal is just to help as many people as I can who have moved over to the UK to actually have a home here and feel comfortable and like have a home for their family. So yeah, it'd be great. Obviously, if you want more information or you got any questions, check me out on Instagram or YouTube, and be happy to help.
Awesome. Thank you so much, Ripley, for the amazing presentation. We really do appreciate it. And thank you, everyone who has managed to join us today. So I'm just going to run through what we do at Tulia. So at Tulia, we offer immigration advice and holistic support for migrants. These are some of the services that we offer. If you may be interested, maybe you want to apply for a visa, skilled worker, visitor's visa. Maybe you got a refusal on an application that you made to the Home Office. We can help you with that. And any, advice on immigration, really, that's what we specialize in. And you can book a consultation with us on our website, www.tulia.org.uk. You can also follow us on social media platforms. You're there on Facebook, Instagram. We'll be sharing like latest immigration advice, updates, and things like that. You can also volunteer, and we're available on WhatsApp from 9 to 5 p.m. Monday to Friday. If you have any questions that you may need to ask, please feel free to do so. Otherwise, thank you all for joining us. We will be sharing this on our YouTube channel, this recording, so be sure to check it out. Thank you, everyone, for joining us, and have a good evening. And thank you so much, Ripley, for joining us.
Thanks a lot. Thanks for having me.